At its meeting on monetary policy today, the Monetary Board decided to keep the interest rate on the BSP's overnight reverse repurchase facility unchanged at 4.75%. The interest rates on the overnight lending and deposit facilities were likewise held steady. The Monetary Board's decision is based on its assessment that prevailing monetary policy settings remain appropriate. Latest baseline inflation forecasts show inflation setting within the target range of 3% plus or minus 1% percentage point for both 2019 and 2020, while inflation expectations continue to stabilize within the target band. Inflation pressures have eased further since the previous monetary policy meeting, reflecting mainly the decline in food prices amid improved supply condition. Meanwhile, the Monetary Board observed that overall prospects for domestic activity continue to be firm, supported by a projected recovery in household consumption and continued implementation of the government's infrastructure program. However, there are risks to economic growth in 2019 if the current budget impasse in Congress is not resolved soon. The Monetary Board also noted that the risks to the inflation outlook remained broadly balanced for 2019, even as it observed that further risks could emerge from prolonged El Nino and higher than expected increases in global oil and food prices. For 2020, the risk leaned toward the downside as tighter global financial conditions and geopolitical risk temper global economic activity and potential upward pressures on commodity prices. Given these considerations, the Monetary Board is of the view that the within target inflation outlook and firm domestic growth support keeping monetary policy settings steady at this time. Looking ahead, the BSP will continue to monitor developments affecting the inflation outlook to ensure that the monetary policy stance remains consistent with its price stability objective. Thank you.
At this point, we would like to request Deputy Governor Ginigundo to share with us the BSP's inflation forecast for 2019 and 2020.
We will recall that in the last meeting of the board in February 2019, we announced our forecast at 3.1 for 2019 and 3% for 2020. For this meeting of the Monetary Board, the latest forecast indicates that inflation would be 3%, so down from 3.1 in 2019 and 3% as well for 2020. We expect that the trajectory, the downward trajectory of inflation will continue throughout 2019 through 2020. By 2020, we expect that this is going to stabilize at around 3%. There are 4 reasons for the forecast. The major reason, of course, is that the February actual inflation, which came in at 3.8%, was a little lower compared to the forecast of around 4%. So that's the major reason for the lower inflation forecast for 2019, from 3.1 in February to 3% for March 2019. There are other reasons for the expected downward trajectory of inflation for 2019. One is lower Dubai crude oil prices. Compared to 2018, Dubai crude oil prices averaged around 65 $69.41 dollars per barrel. For this meeting, we are looking at about $64 per barrel for 2019 and $63 dollars per barrel for 2020. There are, of course, some risks. From the time that we did the projections and the computations for discussion at the board, because the futures prices of oil as of yesterday indicated an upward trend. So this is something that we need to monitor between now and the next meeting of the Monetary Board. The second is the negative base effects. We expect the negative base effects to continue from the beginning of the year up to April of 2019, and from through October of 2019, from July up to October of 2019. So the impact of the supply shocks, including oil, food, and excise tax, are expected to dissipate by the time. The third is the decline in world non-oil import prices growth from positive 1.9% to negative 2.7% due to lower food and metal prices. And finally, we also expect some mitigation coming from the impact of the rice tarification bill, which is expected to start in April of 2019. So those are the reasons why in 2019 we're expecting a smaller, a lower forecast of 3% versus the previous month's 3% forecast for the entire year of 2019.
Thank you, Deputy Governor. We now open the floor to questions or clarifications from our media friends. Since we are live on social media, we would like to remind you to please stand up, state your name and your organization before asking your question. Thank you.
Good afternoon, Siegfried Delgado of Bloomberg. Governor, I'm just wondering, it seems at least that for market watchers, the reserve requirement ratio is back into play. So I think it bears asking whether it's even discussed at today's policy meeting. And also, moving forward, would you treat any adjustment in RRR as a mere operational adjustment or a monetary move aimed at influencing liquidity dynamics in the financial system? And if it's the prior, what are the tools that you're looking at deploying to ensure that any tweak to the ratio is policy neutral? Thank you.
Well, it's a very good question. The reserve requirement may be considered an operational or a procedural adjustment in the sense that we want to migrate from the use of blunt monetary instrument like the reserve requirement to a more market-based instrument like the TDF. And under the BSP Charter, the new charter approving the authority to be given to the BSP to issue its own debt securities, then we have the more basis we have in migrating from the blunt instrument of RR. In that sense, it could be considered to be operational. At the same time, it can also be considered to be driven by the motivation to achieve some capital market reform. Okay, we want to ensure a level playing field between those financial institutions under the supervision of the central bank. Those financial institutions are subject of the reserve requirement. So in a sense, people would argue that the reserve requirement is a tax on the banks. Whereas some other credit granting institutions like real estate developers, for example, are not subject of RR. So it's something that one can consider to be part of the capital market reform. Now, having said that, it is also difficult to argue that the reserve requirement is purely operational or a capital market reform. Because anything that you do with the reserve requirement will have some monetary implications. At this point, when you reduce the reserve requirement by 100 basis points, that it infuse the market with between 85 to 90 billion pesos. Okay? And all other things being equal, that could add pressure to inflation or price movement. Okay? So the issue of reducing the reserve requirement is a live issue. Again, I will repeat myself here. It's a live issue. It's always on the table, but the issue is timing. We want to make sure that when the reserve requirement is adjusted, this is consistent with monetary policy. Okay? This is discussed time and again at the board, but the board agrees that it is important that we get the timing right. So this is the decision on the reserve requirement will have to be related to the outlook of on inflation. The same considerations that we look at when we discuss and decide on the thrust of monetary policy based on the policy rate. So it has been discussed, and it is continually discussed at the monetary board. And again, the issue is timing.
Thank you, Deputy Governor. Are there any more questions?
Good afternoon, sir. Melissa of Business World. Sir, I would just like to ask more about the mention or the stress on economic growth in the statement. I understand it's not a usual inclusion in previous statements. So is it safe to say that the BSP has grown more cognizant or about its role towards economic growth as well? Thank you.
We have always been cognizant that monetary policy is very much a tool for promoting price stability. And in turn, if you have price stability, that can also promote higher economic activity. Remember that in the Charter, the mandate of the central bank, the primary mandate of the central bank, is to achieve price stability conducive to balance and sustainable growth of the economy, and in the latest version of the Charter, and employment. So this is something that follows from the legal provision that monetary policy should promote price stability, not for its own sake, but price stability is an important component of economic growth. When there is price stability, the purchasing power of the people is preserved and protected. And if the people are facing stable prices, consumption expenditure becomes even more robust. So that promotes economic growth. So I think we should not put too much meaning on the mention of domestic economic activity. Remember that even in previous press statements, we've always been cognizant of economic growth.
Thank you, Deputy Governor. Any more questions? Yes. I see 4 hands, so one at a time. So we'll have Bruce first. Okay.
Good afternoon,
Please
Bruce
stand up,
Rodriguez
Bruce.
Good afternoon, Bruce Rodriguez from ABS-CBN News. I'd just like to follow up on that. Right now, given that economists, analysts, even government officials are expecting growth to really slow down because of some domestic factors like the budget impasse, etc., how does that maybe complicate or maybe add another a certain level of dimension into how the Bangko Sentral ng Pilipinas decides on monetary policy or defines its stance?
The Monetary Board remains singularly focused on its primary role of promoting price stability. It is always conscious of the need to maintain price stability in the economy. The Monetary Board is conscious that the 175 basis point tightening from May up to November of 2018 would have that initial impact of tightening the monetary conditions in order to prevent further second-round effects and to ensure that inflation expectations remain well anchored. So even the decline or the slowdown in M3 and domestic credits are the necessary outcomes of the 175 basis point increase in the policy rate of the BSP. We need to tighten monetary policy at that point in order to ensure that we achieve our targets. And for 2019 and 2020, the positive results are already more apparent. As we said, the inflation forecast for 2019 and 2020 are now 3% for 19 and 3% for 2020. So the results are beginning to be seen, and the results are very favorable and consistent with the thrust of monetary policy.
Thank you. Yes, sir.
Afternoon, sir. MJ Bondihar from SMNA News. For the record, what are the effects of in the economy if this budget impasse will prolong?
Well, when there is a budget impasse, expenditure could slow down because you are operating within a reenacted budget. It is contractionary in the sense that the reenacted budget is based on the previous budget. And that budget for 2019 is definitely higher compared to the budget in 2018. Of course, there are exceptions. There are exceptions when there is a delay in the expenditure because we are moving into a midterm election. And normally during midterm election, there's a ban on the conduct of public works project. And that could impinge on economic growth. But my understanding is that big ticket items, expenditures on big ticket items are exempted from this ban, especially those that have been started before. In other words, ongoing public works projects are exempted from such a ban. So the issue there is the commitments that you made in 2019, which may not be covered by a reenacted budget, are the ones that can be affected adversely if the impasse is not resolved very soon. But our report indicates that this budget impasse is about to be resolved. And if that happens, then we should be able to see more positive outcome moving forward.
Thank you, Deputy Governor. Any more questions?
Gov, good afternoon. Mika Flores of Nikkei. The Federal Reserve, in its own meeting, has kept its federal funds target rate, and the Fed has signaled that it will keep rates steady for the considerable time being. I understand that the BSP pursues its own independent monetary policy, but how does the Fed's moves impact in terms of the effect of interest rate differentials on capital flow movements, and does the decision of the Fed today, is it already factored in your baseline forecasts?
Well, we considered that in the discussion of the board this morning. There are two components, the latest decision of the U.S. Fed. One is zero probability that there will be another rate cut in the year 2019. And second, the normalization of its balance sheet will stop for the moment, which means that there is a pause. So in the past, whenever the U.S. Fed starts jacking up interest rates, emerging markets, because they are small and open, are somewhat forced to make some adjustment to prevent capital outflows or sudden stop of capital. Now, I think in our case, we are not in that situation. The macroeconomy is fundamentally sound and stable. We have enough reserves equivalent to about 7.3 months of imports of goods and services. So the pull factors are here, and they're positive, and they can keep capital in the domestic markets. Now, the recent decisions of the U.S. Fed precisely actually improves the situation. And that's one of the reasons why there was less volatility in the foreign exchange market today. That gives more flexibility or space for many emerging markets to keep their monetary policy steady. And we discussed that during the board meeting today.
Thank you. Any more questions? Maybe we'll take the last question, unless, okay.
Governor Siegfried again of Bloomberg. Just wondering about the wave of disinflation, and coupled with the fact that the Fed has been very cautious in its policy normalization. I'm wondering how is that affecting or complicating, or has it been complicating in any way policy making, particularly for us, because we're a nation that's completely very vulnerable to swings in oil prices, for example,
Same answer, because that's the same question
phrased
of
differently.
Nikkei. Yeah.
Yeah. Okay.
Thank you
Thank
very
you.
much for that question. Sig.
Thank you. Do we have a last question? Okay, no more. If there are no more questions, we would like to thank everyone, including those watching us live on Facebook, for their time and attention this afternoon. Maraming salamat po.
Thank you.